What defines a turning point? It doesn't always make headlines. A turbine in the desert, a grid stabilizing, a deal negotiated with purpose. It starts small. What defines a turning point? It doesn't always make headlines. A turbine in the desert, a grid stabilizing, a deal negotiated with purpose. It starts small. From clean energy to digital access, AFC's portfolio is reshaping Africa's business landscape. 166 projects across 36 countries, over 7 million jobs supported. See how capital becomes impact. Visit africafc.org.
Hello, everybody. I think we're about to begin, so if everyone can please take their seats. Whoa. Well, good morning, or good mid-morning, distinguished guests, colleagues, and friends. On behalf of the Business Council for International Understanding, it is my pleasure to welcome you to the 6th AFC Country Stakeholder Symposium. We are truly honored to collaborate with the Africa Finance Corporation in convening this important dialogue, and we are grateful to KRL International for their partnership in bringing this event to life. At BCIU, our mission is to build trusted partnerships between the public and private sectors to advance sustainable economic growth and investment around the world. We connect business leaders and policymakers to foster understanding, strengthen collaboration, and identify opportunities that translate ideas into action. Today's gathering reflects that spirit of partnership, bringing together leading institutions, investors, and policymakers to exchange insights and drive collective progress. With such an accomplished and diverse group in this room, and others joining us virtually from across the world, we are confident that this will be an impactful and thought-provoking session. To begin our program, we'll start with a short video highlighting the Africa Finance Corporation's work and impact across the continent. Please turn your attention to the screen for the AFC introduction video. It is now my pleasure to invite Mr. Samela Zubairu, President and Chief Executive Officer of the Africa Finance Corporation, to deliver the opening address. Mr. Zubairu has been instrumental in transforming AFC into one of the continent's leading multilateral financial institutions, championing industrialization, value creation, and infrastructure-led growth across Africa. Under his leadership, AFC has become a global benchmark for impact-driven investment. Please join me in welcoming Mr. Zubairu.
Good morning, distinguished colleagues, partners, and friends. I'd like to welcome His Excellency Ismail Nabe, Minister of Planning and International Cooperation, Guinea, Mr. Claver Gatete, Executive Secretary for United Nations Economic Commission for Africa, Mr. Roosevelt Ogbonna, the CEO of Access Corporation, our shareholder, all protocols duly observed. It is my pleasure to welcome you all to our 6th edition of Country Stakeholder Symposium. This is a critical time. Africa's growing population, rapid urbanization, emerging continental free trade area, digital economy, as well as our vast natural resources, which includes our arable land, critical minerals, rare earths, significant energy potential, such as our massive 400 billion gigawatts, so 400 gigawatts of thermal power, 340 gigawatts of hydropower, 10,000 gigawatts of solar, 110 gigawatts of wind, and 15 gigawatts of geothermal power. Position us as an engine for global growth. Today, we're here to address one question: how do we unlock Africa's wealth to finance our transformation? We have an estimated $4 trillion in domestic capital pools on the continent, along with even greater global liquidity, which remains on the sidelines. Current investor appetite is deterred by high-risk perceptions and exchange rate volatility. This is despite empirical evidence showing that African infrastructure has the second lowest default rate globally, with very strong recovery rates of over 70%. Our own experience at AFC indicates over 80% recovery rate. The challenge I want the panel to address today is how do we create institutional execution, policy reforms, and risk innovation for structured intermediation. These are the foundations for the financial instruments that can mobilize Africa's $4 trillion to finance railways, industrial parks, transmission lines, data centers, airports, and seaports. The infrastructure we need to support Africa's urbanization and continental free trade area aspirations. Today's convening builds on the successful roundtable that we held last month alongside our partners, the U.S. Development Finance Corporation, on the sidelines of UNGA in New York. That event inspired discussions yesterday at the Milken Institute on building on an African infrastructure asset class. And even this morning, at the G20 Presidency IIF Summit, we continue to have those conversations on how to finance resilient infrastructure across Africa. Now, some very important takeaways from that event in New York last month. So in that room, we had a lot of alternative asset managers, a lot of US pension funds, African pension funds, all having a conversation on how we can mobilize capital to work in Africa. I had a sidebar with some of the alternative asset managers, 2 of them, and they said something that was very striking. He said this is his first event where Africa is discussed, and he didn't know that Citibank had 14 branches or 14 offices in Africa, that he didn't know that JP Morgan had 3 offices in Africa, and he didn't know that Bank of America was doing business in Africa. And that if all of these banks are doing business in Africa, then they have to do business in Africa. And that if there's one thing that he wants us to focus on, because he had all the conversations around risk mitigation and risk management, is how can we work together to get the US banks comfortable to do business in Africa? Because once US banks can do business in Africa, then the alternative asset managers with several more $1 trillion would find a way to do business in Africa. But that we should be comforted by the fact that they don't need the guarantees that the bank needs. In his words, our business is built on their inefficiency. So we need to continue that conversation today around how we get investors comfortable with the Africa risk. So 3 key takeaways have emerged from all these conversations. The need to leverage the knowledge of African institutions like AFC and other multilateral development bank institutions and other African financial institutions to overcome risk perceptions and build trust with global investors. These estimated pools have grown by 100 billion since last year, driven by additional private savings, expanding national reserves, and rising gold assets. Our challenge on the continent is clearly not an absence of capital. We do have capital. It's just trapped. It is the absence of mechanisms to channel capital into Africa's much-needed structural transformation for jobs creation. Job creations, I say, must be the focus for development finance and for mobilizing capital to transform Africa. That is why AFC was created several years ago. In fact, 18 years ago, AFC was created to be that execution engine that will transform Africa's potential to prosperity for its people. And that's what differentiates us from other financial institutions, our focus on execution. We combine project development expertise, our ability to de-risk and develop bankable projects, with our capital mobilization expertise, deploying our own balance sheet and credit enhancement tools to crowd in global investments. I'll give you a few examples. First, the Lobito Corridor. Very topical here in the US. Lobito is an economic corridor that will provide a lower cost and lower carbon gateway to African integration and global competitiveness. We stand here today as lead developers of that project, executing on a promise that was made at the US Africa Leaders Summit in 2022. Since that meeting, we signed an MOU in 2023 constituting the project consortium, which comprised the governments of Angola, Zambia, DRC, the US representing the G7 Partnership for Global Infrastructure Investment, PGII, the European Union, and the African Development Bank. We initiated and completed the feasibility study, welcomed the government of Italy with a commitment of 330 million, which has already been disbursed, I must say, secured a concession agreement with the government of Angola and Zambia in 2024, committed up to 500 million in financing Lobito-Zambia Greenfield Rail, welcomed the AFDB's commitment of 500 million to support the project, executed a grant agreement with the European Union, and secured the signing of intergovernmental agreements between the government of Angola and Zambia in April 2025. We remain on track to break ground by 2026. This model builds on earlier success, such as the first IPP in Ghana, which remains the template for PPAs in the country. I say that because part of the impact that we deliver is how we work. When we do a project and develop a project, we ensure that we consider all the variables and we consider transition across several governments. We consider the interests of both the public and the private sector and ensure that those interests are aligned in such a way that we don't have to replicate templates. We can just use what works. We've done the same thing in Senegal, where we advised the government that instead of trying to draft another PPA, let's work with the last PPA that you are comfortable with and build on that. It is such templates that allow for the replication of success that is needed to advance Africa's development. We also built the first IPP in Cape Verde and Djibouti, and the Gabon Special Economic Zone, an important project that was going to help the country transform their economy beyond hydrocarbons to timber and minerals and metals. That is an example that has gone beyond the country to 14 other African countries, an example that has been able to recently attract international investors for the first time in Africa. We have Vision Invest making an investment of $300 million. I mean, yesterday, Miguel was saying that he didn't know that that was going to be possible until He read about it. So another demonstration of the fact that once you use African capital to prove a concept, global capital will follow to scale that ambition. These projects represent a new model of Africa-led private sector-driven infrastructure development made possible by AFC's leadership. They demonstrate that African capital and project preparation expertise are critical to mobilizing foreign investment at scale. Importantly, they show the world is converging around a new framework for partnership with Africa, one that moves away from aid and prioritizes investment as the lever for economic transformation at home and global supply chain resilience. This rationale is also driving US commercial diplomacy initiatives in DRC and Rwanda under the Regional Economic Integration Framework. At AFC, we'll continue to lead by example, deploying every dollar for multiplier effect, focusing on transformation to create jobs that will contribute significantly to GDP growth, ensuring that local value capture and retention lead to enhanced revenue mobilization. By enhanced revenue mobilization, I want us to take a step to understand what that means. So if we take Guinea, for example, Guinea produces 140 million tons of bauxite annually. And for that, they will earn something like $7 billion in export revenue. So imagine the tax on that. It's just a simple 10%. So that means they will earn $700 million in tax revenue. But if they transform that to alumina, it will generate $21 billion. And 10% tax on that is $2.1 billion. Now, if they are serious and work towards producing aluminum, it will be $75 billion in revenue. And imagine the jobs that we created in that process and the multiplier effect for their GDP. Their GDP will simply double if they focus on transformation of bauxite to aluminum in their country. Same example with iron ore, same example with manganese, same example with several other critical minerals and rare earths that we have on the continent. At today's prices, we are losing $70 billion by not transforming Guinea's bauxite. Distinguished guests, investors, and strategic partners, let's work towards unlocking 5% of Africa's 1.7 trillion institutional savings, just 5%. I say 5% because we've managed in Nigeria to create asset allocation of 5% for pension funds, 15% for infrastructure bonds, 5% for private equity and venture capital. We need to find a way to make this uniform across the continent. Every pension regulatory agency should have specific asset allocation along these lines. I say this because in countries like South Africa, they hold 70% of this $400 billion that we have, $450 billion that we have in pension assets. Imagine the impact of that. In countries like Egypt, Morocco, Kenya, with similar savings, imagine the impact of that. This will help not only in mobilizing additional capital, but will also find transmission mechanisms for local currency financing in those various countries. Again, we have an example in Nigeria where we created InfraCredit, working with the Nigerian Sovereign Investment Authority and PIDG. We're providing investment-grade guarantees to pension funds to invest locally in the economy. We need to find a way to replicate this at scale. 5% is not a big target. Let's work towards ensuring that we can generate $85 billion from our non-bank savings to work for Africa. With that capital, we can transform Africa's high-grade iron ore into steel, bauxite into aluminum, and battery precursors, cathode precursors in the copper belt of DRC, Zambia, and Angola. We can expand transmission lines for stranded hydropower in Angola to the Lobito corridor, to the South African capital pool, and use that to demonstrate our earlier studies, which we arranged about 3 years ago, which showed that it is more economical to produce battery and cathode precursors at the source of material in the copper belt than anywhere else in the world. Cheaper than in China, Poland, the US, everywhere else. And with the vast hydro potential in Angola and DRC, it means you can produce green battery precursors. So we can have further industrial decarbonization taking place on the continent. Again, building on an example of what we have demonstrated in the DRC, where we're using one of the renovated Inga hydro dams to produce Africa's largest copper smelter. Again, demonstrating that we can indeed and have the resources for industrial decarbonization to take place at scale on the continent. I invite you to join us in framing the policy reforms for asset allocation and structure intermission that will lead to more dynamic and integrated capital markets on the continent. Africa's challenge is not a lack of opportunity, it is a lack of our capacity to execute at scale. At AFC, we have forged our identity in execution. Execution is our DNA. Let us work together to transform Africa's vast potential to prosperity for our people by demonstrating that Africa's $4 trillion in domestic capital pools is indeed what is required to start the journey towards Africa's prosperity. Thank you.
Thank you so much. We are honored to now hear from His Excellency Ismail Nabe, Minister of Planning and International Cooperation of the Republic of Guinea. Your Excellency is a dynamic leader advancing Guinea's economic transformation and partnerships for sustainable growth. Your Excellency, the floor is yours.
Good morning, everybody. Good friend. And I have good friends here today. Thank you very much, AFC, for this invitation. It's very timely. As rightly showed off, Guinea, very blessed of natural resources. But also, apart from bauxite, we have iron ore, the Simandou project, which is, we're inviting you on the 11th of November, 11 a.m., where we'll be inaugurating the railway, 650 kilometer, and the port as well in the country that's transformed this. You're right about the bauxite. If you take a country, tiny country, Bahrain, Kingdom of Bahrain, no mineral, no bauxite, but they're having the biggest aluminum smelter out of China. So our objective is pretty much do the transformation that the President, General Mamadi Doumbouya, wants to do for our country. So, ladies and gentlemen, friends, it is an honor for me to join you today at this important symposium that I wish to thank the African Finance Corporation and its partners, BCIU and KRL International, for convening this dialogue. How, as Africans and global partners, we can turn Africa's vast domestic wealth into powerful engine for transformation. We meet here today in Washington, D.C., not merely to discuss finance, but to confront a defined paradox of our continent. Africa is rich in minerals, in energy, in arable land, and also in people. Yet too often, we remain poor in infrastructure, in manufacturing capacity, and also in access to affordable capital. This paradox is not inevitable. It is the result of a global financial architecture that has always worked for us, and equally in our own limited capacity to mobilize and channel the immense liquidity that already exists within Africa. As my brother said just now, the African Finance Corporation research revealed a striking truth. Africa's domestic financial assets now exceed $4 trillion, including about $1.2 trillion held by institutional investors, such as pension funds, insurance companies, sovereign wealth fund, and development bank. These figures should change how we think about financing development. Africa is not a capital poor. Africa is a capital fragmented. The challenge is not the absence of money, but the absence of mechanism. Mechanism to pool, de-risk, and align this domestic capital with long-term investment in infrastructure, energy, and industrialization. This is what I believe is the central question before us today. How can we transform African wealth from dormant balance sheet into dynamic productivity assets? For decades, our economies has been built on extraction, on not transformation. We have exported iron ore, bauxite, copper, crude oil, only to import steel, aluminum, electronics, but also refined fuel. We have shipped our raw material, cacao and cotton, only to import chocolates and textile at many times the price. This pattern has derived Africa not only of revenues, but of resilience. Industrialization is the antidote. It's also the bridge between resource wealth and shared prosperity. Friends, industrialization cannot happen without long-term pattern capital, the kind that comes from speculation inflows, but from institution commitment to Africa's future. Ladies and gentlemen, to catalyze our domestic capital pools, we must take 3 decisive steps. Number 1, we must create the right instrument. Africa needs investment vehicle tailored to our realities, blended finance facilities, regional guarantee funds, and green industrial bonds that can be crowded in domestic institutional investors. AFC itself is a model to this, a demonstration that African capital can finance African infrastructure. Second, we must build credible pipelines. Pension funds and insurers should not invest in uncertainty. Government might therefore focus on the project preparation, transparency regulations, framework, and credible risk-sharing mechanisms that make infrastructure and industrial projects bankable. In Guinea, under the Simandou 2040 vision, we are developing such an integrated model, linking mining, railway, energy, and education, financing through partnerships that blended public-private partnership and domestic resources. The Simandou 2040, which is based on 5 pillars. Number 1 is agriculture, industry, and then commerce. Number 2, education, and then culture. We need to make sure it's based on human capital. Number 3 is infrastructure, transportation, and technology. Number 4 is finance, economy, and insurance. And last one is healthcare and well-being. These 5 pillars is based on what we call human capital, rule of law, and fight against corruptions. Unlocking African wealth is not just a financial exercise. It is a new social contract. When African pension fund invests in African infrastructure, it means that workers' savings are financing their children's schools, their electricity, their roads, and their future. When sovereign wealth fund co-invest in industrial corridors, it means that the value of our minerals is being recycled into productive asset that will outline the mine itself. This is the true mechanism of resource-based sovereignty, not isolation, but also intelligence ownership, not dependency, but partnerships on equal terms. Let me also emphasize, mobilizing African domestic capital doesn't mean turning away from global partners. On the contrary, it creates a stronger, more confident Africa that can engage the world from a position of strength, offering bankable opportunity, not played for aid, but for partnerships. We invite our partners here today, from international financial institutions, developing agencies, and private capital, to walk this path with us, to co-invest in African transformations, not merely in African resources, to see value chain, not just commodities, to build industries, not just extract wealth. Ladies and gentlemen, friends, as a Minister of Planning International Cooperation of the Republic of Guinea, I speak from a country standing at the frontier of this new era. With the Simandou iron ore project, one of the largest in the world, Guinea is not only exporting minerals, but building railways, power line, training centers, industrial parks that will anchor regional transformations. Guinea was blessed a 2 weeks ago. We get our first rating, B+ from S&P, which is which shows that leadership is a key for our Africa moving forward. Simandou is not just a mine, it is a model in how Africa can turn its natural wealth into lasting prosperity through addition, education, and strategic partnerships. Simandou, as we call it, is a United Nations project, whereby we have Guinea having 15% shares, but also we have friends from Australia, from England, from France, from the United States, that bringing the locomotive, which was delivered in Guinea about 15 days ago, to make sure that we have a friend from Africa as well, which partnering on this project. Friends, unlocking African wealth is not an aspiration, it's an obligation. We owe it to our people to ensure that every ounce of minerals, every hectare of land, and every drop of oil fuel an African renaissance build on industry, on knowledge, and self-determination. Let this symposium, friends, mark a turning point where Africa ceases to be the story of potential defer and become the story of potential realized through our own capital, to our own leadership, and to our own resolve. Together, friends, let us make Africa wealth work for Africa. I thank you for your attention.
It is now my pleasure to introduce Mr. Claver Gatete, Executive Secretary of the United Nations Economic Commission for Africa. Mr. Gatete brings deep expertise in economic planning and financial governance, having served in leadership roles including Minister of Finance and Minister of Infrastructure for Rwanda. His work continues to shape the continent's strategy for inclusive and sustainable development. Please join me in welcoming Mr. Gatete.
Yeah, thank you very much, Honorable Minister Ismail Nabe, my good friend, the Minister of Planning and International Development of Guinea, and congratulations on your B+ with stable outlook. And it was very, very nice for the ECA to support you in this kind of process. Mr. Ismaila Zbairo, who is our host, is just beyond the President and Chief Executive Officer for the AFC. He's a good friend, but also the one who is moving Africa really moving forward. And then we have Madam Hassatu Diop Nsere, Vice President of the Africa Development Bank. She's also not just a Vice President for Finance, she's the CFO, meaning that she has more cash than most people here. Yes. Yes, and the colleagues, Ebru, I know we worked together on the bond in Rwanda. Thank you very much again. It was nice to see you here. Distinguished colleagues, ladies and gentlemen, it is a great honor to join you for this 6th Africa Finance Cooperation Country and Stakeholder Symposium on the important theme unlocking Africa's wealth, catalyzing domestic capital pools for strategic investment, resource industrialization. I wish to begin by expressing appreciation to the African Finance Corporation under the able leadership of my good friend, Mr. Samaira Zabairo, for the kind invitation and for the vision that continues to guide the work of advancing Africa's development finance architecture. I'm equally pleased that the discussion takes place here in Washington on the sidelines of the IMF and World Bank annual meetings, where global leaders deliberate on the very issues that shape fiscal resilience, debt sustainability, and investment flows. It is most essential that Africa's priority form part of our conversation, not as an afterthought, but as an integral pillar of the world's shared prosperity. Excellencies, distinguished ladies and gentlemen, we convene at a time of profound transformation in the global economy. Across the world, nations are grappling with converging shocks from geopolitical tensions, climate-related disruptions, and tightening financial conditions that have left no region untouched. Growth remains uneven, inequality is widening, and many developing countries are facing mounting fiscal pressures. At the same time, the global landscape is being reshaped by powerful forces, accelerating technological change, reconfigured global value chains, and the rapid rise of the green transition. New industries are emerging around critical minerals, renewable energy, as mentioned, and digital innovation. However, access to affordable finance remains deeply unequal. Capital continues to flow where it is already abundant to economies already seen as safe and investment grade, while developing regions, particularly in Africa, they bear the highest cost of borrowing. This compels us to ask a fundamental question: how can Africa position itself not at the periphery of global transformation, but at the center, as a continent that produces, innovates, and invests in its own future? Excellencies, Africa stands at the heart of the global realignment. Ours is a region endowed with abundant natural resources, as mentioned, a dynamic and useful population, and growing pools of domestic capital managed by pension funds, insurers, sovereign wealth funds, and development banks. Paradoxically, only a small share of this wealth is channeled into the productive sectors that can drive industrialization and inclusive growth. At the same time, many African economies continue to face extremely high borrowing costs, limiting financing for infrastructure, value addition, and green transition. Furthermore, the continent remains a net exporter of raw materials and a net importer of finished products, an imbalance that perpetuates vulnerability and constrains opportunity. Unlocking Africa's wealth is not about discovering new resources. It's about redirecting existing capital towards our collective priorities and creating the confidence that investment in Africa yields predictable and sustainable returns. That's the essence of our task today. In this regard, Excellencies, allow me to highlight 6 priorities that can help us move decisively from potential to prosperity. First, in addition to domestic resource mobilization and capital market development, we must realign national financial strategies with the goal of industrial transformation. Fiscal and monetary policies should explicitly support long-term investment in the productive sectors, including agriculture, manufacturing, infrastructure, and energy. At the same time, we must confront a persistent contradiction. Despite a combined GDP of over $3.5 trillion and a population exceeding 1.4 billion, intra-African trade remains way below 20% of the continent's total trade, compared to more than 60% in Europe and Asia. This means that African countries trade more with distant partners than with their own neighbors, a reality that fragments markets, limits scale, and suppresses the very industrial linkages that could drive job creation and shared prosperity. The African Continental Free Trade Area, in this regard, provides a potential framework to achieve this by connecting markets, harmonizing standards, and enabling regional value chains that make African industries globally competitive. Industrialization must not must no longer be the byproduct of growth. It must be its own driver, and it must be financed first and foremost by African resources. Second, we must modernize regulatory frameworks to empower institutional investors, including pension funds, insurers, and sovereign wealth funds, to allocate capital towards long-term, higher impact assets. Too many frameworks are restricted to short-term, low-yield instruments that do little to transform economies. Indeed, ECA's joint work with MIDA amply demonstrates that with the right governance, transparent regulation, and effective risk management systems, African pension funds can safely invest in infrastructure, manufacturing, and renewable energy. Clear and stable regulation leads to confidence, and confidence in turn leads to the flows of capital. Third, we must deepen and integrate Africa's financial and capital markets to enable liquidity, scale, and cross-border investment. Initiatives such as the African Exchanges Linkage Project, African Bank's Pan-African Payment and Settlement System, and nascent regional bond markets are today laying the foundation for a more unified continental financial ecosystem. Greater integration will help African savings to saturate within Africa and support the financing of African enterprise rather than being diverted to distant capital markets. Fourth, we must de-risk investment and expand private sector participation through innovative financing structures and partnerships. Guarantee mechanisms, credit-enhancing tools, and blended finance models are essential to reduce perceived risks and attract both domestic and global investors. For example, the DRC Zambia Battery Initiative, supported by AFC, Afrexim Bank, and ECA, illustrates how coordinated policies, joint platforms, and shared incentives can open up investment in complex cross-border industries. When Africa de-risks together, it grows together, and the private sector becomes a full partner in this transformation. Fifth, we must build credibility, transparency, and investment-grade performance across the continent. Prudent debt management, sustained fiscal discipline, and reliable data are key to reducing perceived risks. In this spirit, the ECA continues to advocate for the African-centered credit rating agency that complements existing global institutions and ensures that African economies are assessed on the basis of facts, not assumptions. Achieving investment-grade performance should therefore be a shared objective as it embodies the trust, predictability, and stability investors seek. Sixth, we must invest in institutional capacity, innovation, and partnerships to sustain Africa's financial growth. True transformation requires strong institutions, skilled professionals, and an ecosystem that nurtures innovation. Through collaboration with the AFC, Africa Development Bank, and the Afrexim Bank, the ECA is supporting member states to strengthen public finance systems, develop domestic bond markets, and design innovative instruments such as the green and resilient bonds. Crucially, these partnerships must deepen private sector participation because it is through private innovation and enterprise that we can translate national policy and productivity and investment into tangible impact. Excellencies, distinguished ladies and gentlemen, it is most encouraging to know that these priorities are already taking shape. Across Africa, we see countries reforming pension systems, linking exchanges, developing regional corridors, and embracing digital tax and customs systems under the Africa Continental Free Trade Area. The challenge now is to scale these efforts to create a coherent continental financial architecture that rewards performance, crowds in private sector, and ensures that every dollar invested in Africa works for Africa. With the right leadership, alignment, and ambition, we can transform Africa's wealth into lasting prosperity for its people and the generations to come. And the Economic Commission for Africa is ever ready to continue working with our member states and institutions such as the AFC, the Africa Development Bank, and the Flexim Bank to advance this shared agenda. Together, we can build an Africa that produces what it consumes, trades what it makes, and invests confidently in its own future. I thank you very much for your kind attention.
Thank you, everyone. We'll now transition to our panel discussion with a short impact video highlighting AFC's work.
What defines a turning point? It doesn't always make headlines. A turbine in the desert, a grid stabilizing, a deal negotiated with purpose. It starts small. From clean energy to digital access, AFC's portfolio is reshaping Africa's business landscape. 166 projects across 36 countries, over 7 million jobs supported. See how capital becomes impact. Visit africafc.org.
We will now transition to our panel discussion titled Catalyzing Domestic Pools for Strategic Investment in Resource Industrialization. To guide this important conversation, we are joined by Ms. Hadiza Bouj, a seasoned moderator and journalist, formerly with CNN, who brings a wealth of experience in international affairs and development. Hadiza, over to you to introduce our panelists and lead the discussion.
Good morning, ladies and gentlemen. I hope everyone is still excited to continue this panel. Thank you for braving DC's formidable traffic and government shutdown to join us this morning. I'd like to introduce our guests. I'm going to start with the lady who has the most cash, apparently. So that would be Ms. Hassatou Diop Nsele. She is the Ms. Nsele is the Vice President and Chief Financial Officer of the African Development Bank, whose leadership has strengthened the bank's global capital markets and operations and innovative finance portfolio. Our next guest is Ms. Ebru Pakan. She's the head of the Middle East and Africa cluster at Citibank, overseeing the bank's work across 59 markets and driving trade and investment flows across the region. Next guest is Mr. Banji Fehentola, the Executive Board Member and Head of Financial Services at the Africa Finance Corporation, who leads the corporation's capital mobilization and financial advisory initiatives. And finally, Mr. Luvuyo Masinda, the Chief Executive of Corporate and Investment Banking at Standard Bank Group, who leads one of Africa's foremost teams advancing sustainable infrastructure and energy investments. As Mr. Zubairu mentioned this morning, the heart of what we're talking about is talking about the pervasive narrative that Africa is a risky place to invest in, and part of all of what you do is to counter that narrative, and I'm sure you deal with it every day. And so we'd like to get into how we can combat that narrative, and what tools and instruments you are recommending as tools to combat that. So we're going to start with you, Banji. Earlier this year, AFC identified approximately $4 trillion in domestic capital across Africa's banking and non-banking sectors. This includes pensions, insurance, and sovereign wealth funds. What do you see as the two major constraints limiting the participation of these domestic capital pools in financing infrastructure development, and how can AFC play a catalytic role in overcoming them?
Yeah, thank you very much. And I think the keynote speakers addressed a lot of the points constraining domestic capital pool in investing in infrastructure in Africa. So maybe some of the things I'll say may just repeat what you already said. But first of all, I think we need to look at it from two sides, two major sides. On the supply side, we need to think about, we keep talking about domestic investors investing in infrastructure. The first question is, are we supplying enough of those infrastructure projects to make infrastructure a viable asset class? I think that's a major problem. And that takes us back to some comments made earlier around project development, how well are we structuring projects so that those projects become bankable for institutional investors to invest in that. We need to remember that the people who are managing institutional capital have a fiduciary duty, right, to the asset owners. So for them, they don't want to lose money. So if you are talking about infrastructure as an asset class, someone needs to spend the time to develop that asset class. And data shows close to 80% of projects fail, even before we get to feasibility stage. So if you think about it as a funnel, it just looks like we're not given enough in terms of quantity as well as quality. For us to get that attention of people managing institutional capital, you obviously need to deliver infrastructure in the right quantity and scale for you to move the dial for them. I think that's important. If you look at it from the demand side is twofold. One, the regulatory environment, and I think a few people touched on that. The asset allocation, all that stuff, that needs to change. But more importantly, if you look at it from the guy who is making the investment, it's easier for me to invest in public stocks and bonds than to invest in complicated, quote and unquote, infrastructure. Because one, I don't understand it. And if I invest in bonds in many African economies, I can make 20%, 30%. So why am I looking for an extra risk premium when the risk-free rate is already so high? So that takes us back to why are those rates so high? And that's largely because governments are borrowing at a level that maybe they shouldn't. They're not raising enough revenues. It goes back to the issue of beneficiation, adding value on the continent, because if we do that and we're taxing a bigger base, a bigger value add, then maybe governments wouldn't need to borrow as much. Interest rates may not be as high, and then you have an incentive for people to think outside of the traditional asset classes to start looking for yield in infrastructure. So I think when you look at it, both on the demand and the supply side, there's a lot of work that needs to be done. And obviously there's the issue of currency, which we talked about earlier on. And last but not the least, I'll just talk about a mindset shift. That's very important for Africans. We cannot be talking and telling the world to invest in Africa when we ourselves are not doing it. So there needs to be a mindset shift from all of us in the room in order for us to see the kind of growth that we'll see in infrastructure.
Thank you. And speaking of institutions that have this type of capital, I'm going to switch over to you, Luvuyo. You represent one of Africa's oldest banks and largest financial institutions, and you have the unique vantage point of sharing the continent's capital landscape. How do you assess Africa's progress in mobilizing its domestic capitals, as he's mentioned, and to fund strategic industrial and resource-based investments?
Thank you very much for having me, to the president of the AFC and all distinguished guests. Yeah, it is very interesting. So on a side note, I was just reflecting. I was on an earlier panel earlier this morning as well, and when I listened to everyone this morning, we are in violent agreement in what needs to happen, and yet it has not, and it continues not to happen. And I think one of the things we do need to talk about is how do we just coordinate with each other better. both across policymakers, the pools of capital that exist, because we seem to have very little disagreements of what needs to happen. But on your specific question, I mean, there's great research work that's been done by the AFC on the amount of liquidity that exists on the continent. And whilst at a headline level, that sounds like a lot of money, not all of it is set up to invest in infrastructure. Yes. For a number of reasons. The first one is almost $2.5 trillion of that is in commercial banks, who by their nature raises liquidity more in a shorter tenor when you compare to the need of a long-dated tenor of infrastructure projects. That's number one, is quite difficult. Secondly, given the regulation rules for banks and the punitive capital rules, that banks are almost disincentivized to allocate, commercial banks specifically, to allocate capital, means we have been very inefficient to leverage this pools of capital that sits on the continent. And then the others around the policy regulation and changes that would need to be made to incentivize non-banking financial institutions, pension funds, improve our savings culture on the continent to attract this capital. And so we're not being efficient, but we think there is work that can be done on that. As part of the work we've been doing for the G20 and the B20 work, we have captured some of those challenges in what we think are important things to really unlock that capital, to relook at some of this banking regulations, especially around the capital, to look and work with rating agencies on reviewing both the real and perceived risk of doing business on the continent, and for that to be more data-based, or for lack of a better word. Yeah. And to also work on the other side with the various sovereigns to better prepare themselves to respond when there are these processes, and so that we come up with an outcome which better reflects reality, and hopefully by that reduce the cost of doing business across a continent, which means we can really be able to leverage more efficiently this deep liquidity that we talk about, of $4.5 trillion. If those things are not in place, it will remain trapped, as the president says. So it's improving, but we're still very inefficient of leveraging that liquidity.
Well, thank you for doing both panels. Appreciate that. So, Ebru, continuing to talk about reforms that are needed. Citi has been a long-standing partner in Africa's development journey, and a key collaborator with AFC on mobilizing capital. And as we're talking about reforms that are needed, what do you see as the investment landscape in Africa amid all these capital flows and this macroeconomic certainty? And what reforms would you suggest that need to be in place to make sure that there's success in this?
So thank you. And first of all, again, thank you very much to AFC for organizing this forum to discuss this very, very important topic, which I think as already said, there is no debate on what needs to happen. The question is how to get there. In terms of the current investment climate, at the expense of maybe stating the obvious, since the pandemic over the last 5 years, for many of the African nations, the international capital markets borrowing costs have significantly increased. If you look at the past 4 years, we are looking at anywhere between 250 to 300 basis points of additional cost. And that phenomenon is not going to change anytime soon, because the rest of the world is also trying to solve for various other problems, including the impact of global tariffs, changing trade flows, geopolitical issues and challenges. When you look at long-term Eurobond markets, half of the African countries don't have access, or they could have access as incredibly high costs. As importantly, another concerning trend is the growth of FDI coming into Africa. It is probably at its lowest over the last 2 decades, representing only 3% of GDP. So when you have that landscape, this conversation that we are having in terms of unlocking domestic capital so that we are able to fix the long-term investment needs on the continent becomes hugely important. And again, I know I'm stating the obvious, but that's the backdrop to what we're discussing here. But then we all know there is great potential in terms of the demographics and the natural resources of the continent. When we think about reforms, well, I think we should firstly talk about the foundational needs and requirements. It's much easier said than done, but because without that foundation, which hinges heavily on what the governments will need to do, it is very difficult to build the next layer of the buildings. And that foundation starts with fiscal prudence. It starts with legal and judicial reforms. It starts with transparency. Some of the keynote speakers already talked about, and actually Banji touched upon, first of all, the supply of projects, but also the transparency around those projects, all the way from the procurement to what the success criteria looks like, how the investments are going to be monetized over time, etc. So these are really foundational, and it does hinge heavily on how governments are going to be looking at these reforms. Then moving on to more practical domestic capital markets and monetization. Clearly, there's a lot of work that needs to be done in terms of those institutional investors. Firstly, still, the institutional investor base, whether those are the pension funds or the insurance companies, etc., is still actually quite small compared to the size of the economies or the population in quite a few markets. The investment into those institutional investor base domestically is the starting point. And we need frameworks for that. We need incentives for that. And that's where some of the partnerships with the international community, whether those are the large insurance firms, whether those are some of the sovereign wealth funds who might be putting seeds on the ground, is important, because first we need to create that institutional investor base. And then we obviously need to produce the products, the instruments that they are going to be able to invest into. I think we already mentioned it's far too easy to invest into domestic bonds, high yielding, easy to invest. And actually the prospectus of many of those institutional investors do not necessarily give them leeway at the moment to be able to go after some of those alternative investment products. So the regulators will then need to think about how to come up with risk-prudent but more expansive instruments that these institutions can invest into. Finally, I think we shouldn't be giving up on the international investor base. There are quite a few sectors where for the international institutional investors where there's going to be opportunities, there's going to be public-private partnership opportunities, and of course the role of the institutions such as AFC becomes crucially important in terms of kickstarting that journey. I'm sure we're going to talk about that a little bit more later, so I'm just going to wrap up there in the interest of time.
Okay. Well, thank you very much. Speaking of which, I'm going to transition to you, and we can talk about those partnerships. We've been witnessing an alignment and collaboration between AFC and AFDB and other regional development financial institutions across the continent to pool expertise and resources. How can the deeper partnerships, as was just mentioned, among African DFIs accelerate the mobilization of local capital at scale and drive transformative investment across the region?
Okay, so thank you very much. But before I answer that,
yes,
it was quite interesting, the exchanges before. And when we're talking about mobilization, it's about crowding in from outside of the continent and about mobilizing from the inside. And with regards to the first question on how do we accompany investors that want to look into the continent, one instrument that we have is partial credit guarantees. And it has been extremely, extremely helpful. It's something that we offer to banks, to Citibank and others that want to invest in Africa but do not have necessarily all the lines, etc. So we do provide this kind of support. And what we've been doing, and which has been quite successful, when you do a partial credit guarantee, you don't guarantee the 100% of the transaction. But what we've done is tranches. So you have a tranche where it's fully guaranteed, let's say, and a tranche where it's 0% guaranteed. And you see a lot of uptake from that, providing to some of these investors can be commercial banks, but also asset managers. And you see that there's starting to be an appetite for that when they see zero risk. We did a synthetic securitization transaction, which was the first transaction done by a multilateral development bank in 2018, where basically we synthesized a portion of our private sector portfolio, $1 billion, in order to sell to the market. It was a first, it was a success, and it's something that is being replicated. You're hearing the originate to distribute model from IDB. We work with them, we supported them in their endeavors, so it's something really that we launched. We haven't done other transactions similarly because basically we've optimized all our balance sheet. So the amount that we have was quite small, and we are partnering with other DFIs, for example, DBSA, in order to have a synthetic securitization transaction that is going to pool private sector transaction from the African Development Bank, but also from DBSA, and hopefully from the AFC as well. But the idea is, in order to, to optimize and make the money work. So that I need to stress, private sector portfolio, through the COVID period, 0% loss. So this is how you can get a demonstration effect. There is a lot of negative perception about the continent, so these instruments provide confidence, and these transactions provide also a demonstration effect. So I wanted to highlight that. And with regards to the local currency capital markets, very, very important. I've been more than 20 years in this business, and I keep on hearing local currency capital markets. And if we had seriously, very seriously considered that, we would be in a different situation. The reason why you're having all this unsustainable debt from our countries is because our markets are too shallow, there is no depth, there is not enough products, they have to go to the international capital markets. And through actions that are totally independent of theirs, they have, you have devaluation, whatever crisis happening elsewhere, your currency is devalued 30%. What it means is your debt increases by 30% by no fault of your own. So we need to go back to the basic, and we need to look at local currency financial markets. When you hear about discussions right now, even at the G20 when they talk about, it's important to have FX, etc., we need to have hedges in order to protect investors. Go back to basics. Those instruments need to happen on the ground in our markets. When you issue in dollars, you can swap in euros. We need to have those instruments, within the country. So I'm quite passionate about that because it's been 20 years, and it's always yes. The local currency capital market is important, but right now we need to find the solution. But if we had thought of that 20 years ago, we would be in a different situation. So I just wanted to make this case.
Yes.
So
yes. I have heard you talk about hybrid capital and SDRs and implementing them in various markets. How do you determine which instrument is best for each of the regions that you tackle, and how do you incorporate them into the planning?
Okay, so just to go back to the AFC, how can we work better with the AFC? And because of the introduction that you made of me, and I think that one of the to provide more resources, right? So, we can talk about everything that we want, but if you don't have the resources, it will remain talk. So it's about how do we resource properly the DFIs that are working on the African continent. The African Development Bank does have a very large balance sheet. We do support African DFIs, but as President Ulta, who's here, likes to say, we are the wholesaler, and the DFIs are the extension, in the sense, of the African Development Bank, in the sense that they are also part of our mandate. So it's about resourcing, how do we best resource them, but also it's about co-financing. We do enjoy a very good relationship with the AFC on the co-financing side. We should deepen it. We work together on the African Investment Forum, and I do invite you to participate at the African Investment Forum that is going to take place in November in Morocco. But it's about showcasing projects that are key projects, transformative projects on the continent that investors, both inside and outside of the continent, can look at. They can ask the right questions, if they're not comfortable with the risk. Because at the same table, you have the sponsors, you have the de-riskers, you have those that provide the guarantees, the funding, etc. So it's a very good conversation, and a way also to pilot, in a sense, the transaction. So there is co-financing. There are the instruments that we can, work on together, and develop together a bankable project. I was very surprised a few years back when I heard, the World Bank saying, one issue is the lack of bankable project. And I thought that was an AFDB specific type of issue. No, it is an issue. So how do we, and that's one of the reasons actually why we launched the Africa 50, because it was about, how do we have project preparation facility in order to, to support this type of project. So there is a lot to be done, but I think that first and foremost, and I think this is one of the things that the President Zubairu indicated at the beginning, is we need to work together. We can be as strong as we can alone, but together we have a power that is, that will optimize. So let me stop there.
No, that's okay. Thank you so much. I appreciate everything you have to say. So speaking of AFC, let's go back to you, Banji. How is AFC, if you can expand further on what she has just told us, and the stakeholders helping to drive the industrialization and value addition? I know you talked about it a little bit before, but if you can get into how does a transformation happen? How is it tangible? How do you show that this is happening when you're turning raw materials into competitive hub for value, and then becoming a contender on the global supply chain?
Yeah, thanks, and thanks for the collaboration. And she did mention that they are also a shareholder in AFC, so let me add that to what you said. That's a reflection of the collaboration between us. So for us, I think it's a matter of strategy. So we figured out quickly that for us to make a major dent, to kind of improve the situation on the continent, we really need to find a way to move Africa up the value chain. And I think that came up in a couple of keynotes today. We need to move from raw materials all the way to, semi-finished as well as finished goods, because really that's really how we convert the demographic dividend that we have into prosperity. So that's important. So for us, a couple of things we're looking at. Industrialization is key. And so our investment strategy today is channeled more towards how do we help Africa to industrialize. So building industrial clusters, and we've done that successfully. I think one of the projects that was mentioned earlier on was Arise. So Arise is a major investment that started from Gabon, Benin, Togo, Chad, and several other countries now. Around the primary product, we get transformed. Beneficiation happens on the continent, jobs are created, and then we're exporting higher value products. So that to me is a good example, and in recent time we've seen collaboration even among the MDBs, Afrexim through FEDA has come into Arise. So that's again a reflection of how African MDBs are working together for industrialization. The second aspect of that to me is really how do we help Africa to build its power and energy access, because you can't industrialize really if you don't solve the power problem, right? So half of the continent today don't have access to reliable electricity. And so for us at AFC, that's an important thing. We invested in Lekela a couple of years ago, partnering with Infinity, Mazda, and a couple of EBRD and a couple of other names. And today that has become the biggest platform for renewable energy on the continent, and we're building and scaling that up significantly because we believe that we need to provide power for the continent to industrialize. Third is energy independence, and I think that's very important. So as part of our strategy, and I believe most MDBs are aligned on this as well, we cannot have a situation where a country produces crude oil, exports it, and imports refined petrol. I mean, that has to change. Yeah. So we invested in Dangote refinery a couple of years ago. And for people, I believe most people know 650,000 barrels per day, largest single train refinery in the world. We invested in Cabinda in Angola, which I believe is 30,000 barrels per day, provides about 20% of Angola's energy. just those two projects alone easily would take up to 33% of import, fuel import by 2030. So when you think about that, that becomes extremely important. So as we think about projects, as we think about industrialization, as we think about how can African governments become, have a better fiscal position, it's about moving up the value chain. And as we move up the value chain, add more value, the tax that they realize from this becomes even bigger. And then maybe we can solve the problem of high interest rates. And once we solve that problem, then the asset managers who are sitting today pretty and enjoying 20, 30, 40% in some instances now need to start thinking about alternative asset classes. So to me, that's the connection between what we're doing and how do we mobilize domestic capital into infrastructure over the long term.
Thank you. Staying on the theme of scaling up and government, the scale of Africa's financing requires collective effort amongst governments, DFIs, and the private sector. How can Standard Bank collaborate more closely with regional DFIs such as AFC and AFDB to mobilize capital for transformative cross-border industrial projects?
Yeah, no, it's a great question, and a lot of it is happening, but I think we'd all agree not at the pace that we would all like. I mean, there are a couple of things that we've done as a bank. When we saw, and I think it was mentioned earlier, the challenge that the sovereigns across the continent face post-COVID, being locked out of the external market, the bond market, for us created an opportunity to how can we structure funding instruments that are cheaper for the sovereigns, and that reduces and eliminates as much as possible the foreign currency risk. And we've actually found that there's a big market and appetite for that. Both the local investors, and so we've been able to syndicate a lot of that to DFIs, to pension funds, and more importantly, to external investors like the insurance market. I think one of the key things on the coordination has to be across all the roles that we play, identifying where is each of our capital best used. It's still too often we are competing across commercial banks, DFIs, and we are not leveraging the capital that sits across all our organizations to the best areas. And so we do have this issue of not enough projects coming in because not enough time is being spent to get them bankable. And so because there's not a lot, those that come in, it sometimes feels a lot like we're competing. And so, but I think that speaks to coordination. We have to spend, more time in coordinating together to identify where is each of our capital pools can be best allocated, and using instruments that FDB is talking about on de-risking a lot of these projects, which I think will attract and provide scale, which will attract even international investors.
Thank you. Ebru, so we talked a little bit earlier about the reforms and all the things that need to be happened, but we're talking now in terms of not only of competition amongst all these development institutions. How does international banks like Citi work with governments, DFIs, and investors to reduce these risk perceptions and unlock more competitive financing in African businesses, while at the same time toward to integrate so that all these projects can be funded?
I mean, to be honest, I wouldn't quite call it competition. I think actually we probably need even more institutions which are able to step into de-risking of various different projects and investments that needs to happen. And one of the roles that we see for ourselves is actually to be able to get that teamwork and collaboration and connecting the dots. When we come across those projects where clearly it's going to be over our risk appetite or balance sheet that we are willing to put under that, to underwrite that project, we absolutely need the DFIs and multilateral agencies and many others to participate to form that collaborative solution. As an international bank, one advantage that we have is to be able to also bring the investors from a broader global base. I think oftentimes people are a bit too tunnel visioned in terms of going after the US and the UK and the Europe, which has been the traditional investment base. But over time, that has changed. And to give you an example, very recently with the Nigerian government, we actually had a big session in Brazil with the investors in Brazil as well as the government itself. So it's time for people to also open up, but then that requires much more education of Africa and what the opportunities are, what the challenges are, what the structures could be. And that's one of the roles that we see for ourselves, and we are trying very hard to be able to scale that. So that's one role that we see. The second thing that I would put out there is structures and instruments and products and the domestic capital market evolution becomes really important, and that point has already been made, but I don't think we can make that point enough. And that requires then advisory work that we do with various institutions in terms of what are the ways of diversifying these instruments, how can we be thinking about new products and new capabilities. And that's the second role that we see for ourselves. Thirdly, interestingly enough, on the continent itself, sometimes it actually requires connecting the dots. On the continent and with the capital pools which are actually closer to the continent, and I'm talking about Middle East specifically. There is a lot more appetite when it comes to renewables, when it comes to food security, when it comes to critical minerals, which are going to be hugely important for the digitization, artificial intelligence, new technology developments. So those capital pools from the Middle East needs to be unlocked. And that's the type of role that, again, we see for ourselves. But this is all in collaboration. I think the point around collaboration is really important because the type of challenges that we are talking about are far too big for any one institution or any one type of institution to solve on their own. Finally, execution requires a great deal of discipline. And that's one of the things that I think international institutions can help in terms of actually setting the KPIs and setting the key milestones and actually being very transparent about what is working and what is not working. Because credibility gets built over time by the success of execution. And the more projects that we have to tell the success story of, the more capital we are going to be able to unlock within the continent, but also from outside.
And before we invite the audience, and thank you, Ebru, before we invite the audience to ask some questions, I'd like to ask each of you to respond from your perspectives as to what the your finance priorities are when we're tackling this issue of trying to unlock local capital and transform the continent. And I'll start with you. I'm sorry, what are the financing priorities of your institutions or your organizations when it comes to unlocking capital and then start to create transformative industrialization on the continent?
So what are the what, sorry?
Financing priorities.
Oh, okay.
Yeah.
So.
It's okay. It's my accent.
No, it's the sound. So in terms of sectoral,
yes.
The African development, it's the mandate of the African Development Bank is to promote social and economic development on the African continent. So the priorities of the African Development Bank are really the priorities of the country. So it's about infrastructure development, and the AFDB is the largest financier of MDB financier of infrastructure on the African continent. It's about food sovereignty, food security. It's about industrialization. You talked about, moving up the value chain. Africa needs to add value, not export its jobs. It's also about, the quality of life, so the social sector. Industrialization, I've talked about. Regional integration also is very important, and also energy. Mission 300 is a very innovative initiative that was launched by the African Development Bank, collaborating with the World Bank and other institutions. It's about bringing energy to the African continent. It's just mind-boggling, the loss of GDP per year. Yeah. The fact that even if you forget about the traditional source of energy, Even in terms of renewables, Africa is leading. I mean, with solar, we can do so much. Yes. And with what we have, we can even do much more. Yeah. So, so basically what we view Africa is, I like to say that Africa is the richest continent in the world. It's also the poorest continent in the world. And we see ourselves as that bridge between the challenges and the opportunities. So these are we cannot do all, and it's important that we partner with other DFIs that are complementary and that do other things as well. So
thank you. And from your perspective?
Yeah, for Standard Bank Group, we currently have invested about $200 billion of assets on the continent. Our purpose is we believe we can drive Africa's growth, and we believe in the medium term that has to be with the unlocking and mobilizing capital around energy and infrastructure. On the energy front, we've given ourselves a target of mobilizing, which includes our own use of our own capital, just under R500 billion over the next 4 years. We're 60% there, so up to 2029. We've mobilized about 300 billion rand, so we're 60% there. And on infrastructure, we believe the role partnering with DFIs and seeking and mobilizing capital, both internal and outside, are the key areas of focus that we've given ourselves. And when we consider that through the lens of each of the markets, the 21 markets that we're in, we see very consistent opportunity, actually. It's not that one market has become more important, but there's a general need that says to us that even our own balance sheet is way too small for what can be done, and so collaboration is incredibly important.
Thank you.
Yeah, I mean, I can agree less. Everybody talked about collaboration. I fully agree with that. I also do agree that there's no one institution that is big enough to tackle the problem. So I think for me, I'll just focus on the how. How do we get there? And I think for us as an institution, when we talk about collaboration, I would like to touch on two things. One, we all have balance sheets, so hopefully co-financing is not the problem, but we need to fix the supply issue. So co-development becomes extremely important because that's the risky part of infrastructure finance. Someone needs to spend money and capital to get those projects to be bankable, to have the right quality, and to get the right scale. I think that's pretty important. But there's a second element which I think we all owe the continent a duty to address, and that's really in the area of advocacy on the policy side. Because everything we say here is nice and beautiful to say, but you cannot do infrastructure without government support. And if we continue in a situation where we're not elevating the quality of governance, on the continent, then I think we will still be struggling and playing catch up. So I think all our institutions need to start thinking about how do we elevate the quality of governance on the continent. I mean, I was so pleased with the minister from Guinea and, the conversation. I almost stood up to clap for him because he was saying the right things, right? So if we can get people to be saying the right thing and doing the right thing, then the issue of the supply of infrastructure, the government needs to understand its role, let the private sector come in, create the right environment, and all of us here will deploy capital. And last but not the least, as financial institutions, we also need to think about how do we get our shareholders, our government, to capitalize us. A lot of the capital that is invested abroad, if it came back to capitalize all the financial institutions sitting here, imagine the amount of dollars we will crowd in, or unlock or use our guarantees to crowd in. So I think there's a lot of work to be done. Those are the areas where we are paying attention, because I think beyond just what amount of dollars we can write on our balance sheet is fixing these structural challenges that will lead to the long-term growth of Africa.
Thank you.
So your question was on the financing priorities, but I think a lot has been already said on that one. I want to just touch upon one topic that we haven't covered so far, which is about a lot more basic than financing. and that's around actually mobilizing or practically executing the African Free Trade Agreement. I think that's actually very, very foundational to a lot of the things that we are discussing, because for some of this supply or for some of the demand around projects to come, the intra-Africa trade and unlocking those flows is hugely important. We are all talking about the resources that Africa has, but it's stuck or it's compartmentalized in different parts of the continent. And in the current environment where the trade flows around the globe are dramatically changing, there's actually a great opportunity for self-sufficiency when it comes to those resources. A lot of policy work has been done around the agreement. The challenges around practically kickstarting and executing. And that's one of the things that is on our priority agenda, to see how do we facilitate, how do we actually help execution of that more practically. We're trying to engage with different governments, trade and foreign trade agencies, and with our clients who are operating in multiple countries in Africa, to see how we can practically help the execution of that. And I think that's a long-term journey. I think a lot of time has been already spent in terms of talking about it. Now we need to do it. Yes. So that's the thing that I wanted to put on the table as a priority for us.
I appreciate it. Thank you. And now we'll take questions from the audience. Okay. All right. Okay. There are 2 mics floating around, so if you have a question, raise your hand and someone will bring a microphone to you. I will read a question in the interim from someone who's watching online. And this is from Warren Lafleur from the Koya Capsule. Given the critical role of innovation in driving sustainable infrastructure development, how can AFC and the AFDB more effectively prioritize the development of local innovation pipelines? Specifically, how can they leverage university research and industrial science councils to foster homegrown. This is a long question, so specifically, how can they leverage university research and industrial science councils to foster homegrown technological advancements, enabling African nations to participate more actively in the industrial decarbonization agenda and similar large-scale infrastructure projects? I can read this 3 times if you need, but yeah. We'll start with you then.
Yeah, it sounds like a PhD thesis.
Yeah, exactly.
But I'll try and answer some part of it, hopefully. Innovation is key, and we're a young continent, so clearly we need to find a way to get all that talent to work. And so at AFC, we've realized this. We're investing in an innovation cluster called Eternal in Nigeria. That's an example of how we're going to do this, whereby we want to create something that looks like an African Silicon Valley, essentially, to tap into the energy, the innovation that sits within the continent. So I think that's an example of how that is going to work. If we're successful there, obviously we'll replicate this across the continent. We also are looking at technology a lot more closely now than we did in the past. Historically, we've looked at technology more from the hardware side of things, fiber, data, and all that stuff. But now we're beginning to think about what else can we do, because we even discovered recently that some of the investments we made, for example, in fiber, actually created most of the unicorns that we know today in Africa came on the back of that investment. So we're also trying to now see how can we do more on the technology side in order to drive innovation. I think there will be a natural connection with the educational sector at some point, because we know that a lot of knowledge sits in the universities, hopefully. So we'll find a way to plug them into what we're doing. And we just need to connect the industry and the classroom somehow to get the best outcome.
Is there anything you want to add?
No, I totally agree. I'm fully aligned, but jokes aside, technology is extremely important, and it's about the youth is much more technologically savvy than the older generation. Yeah. And we're seeing a lot of, in terms of fintech, we're seeing a lot of changes. And this is something as part of the Jobs for Youth approaches or innovation type of funding that we want to do. This plays an important role as well. It's about also promoting science, promoting the youth, and providing the necessary support. But I agree with that.
Thank you. Next question from an online viewer, Musaddiq Mustafa from the Office of the VP. Oh, thank you. From the Vice President of Nigeria, it looks like. What policy and institutional frameworks are required to reduce the risks associated with the infrastructure investment in Africa and enhance the participation of institutional investors, including sovereign wealth funds and pension funds? I think we talked about this briefly before, but I'll pass it over to you to start with, if you have anything to add.
Sure. I think what is starting to emerge, the PPP frameworks that are emerging, which are transparent, predictable, and supported by, people's rights to keep their assets, is definitely the right direction. And we're also starting to find that those PPPs are starting to find the right balance between risk and reward, between the sovereign and investors. But it's not enough. We just need to see that more consistently. And then the issue around governance is really an important one, which we sort of touched on very at a high level. That will be the feedback we'd often get from investors, where it only takes one project where for an investor to have a terrible experience. And we must always remember, investors have many options. They can invest anywhere in the world. And their capital is fungible, and so those would be the key things I would mention.
Thank you. Ebru, would you like to add anything?
No, I think that last point is actually a very, very good point. It's a very competitive world, and investors have options. So getting it right the first time is very important. But I think it's well covered.
Appreciate everything. And it's my honor to have been on this panel with you. I thank you for all your time. I know you have very valuable time. You have cash to go spend. So, I just want to thank you again for the insight that you've granted us today. And thank you to the audience for your rapt attention. But please, let's give them a round of applause Very fascinating. So now, as we get ready to close, I am going to be... we conclude the program. I'm delighted to invite Mr. Mohamed Abdul Razak. He's a Senior Vice President and Head of Capital Mobilization and Partnerships at the African Finance Corporation. He will be delivering our closing remarks. And then I'm going to invite you all to take your leave. And again, thank you so much. Thank you. AFC's mission to drive sustainable and inclusive growth across the continent. Mr. Razak, thank you.
Your Excellencies, distinguished ladies and gentlemen, on behalf of our hosts, the President and CEO of Africa Finance Corporation, Mr. Samaila Zubairu, our Executive Director, Board Member, Financial Services, Mr. Banji Feintola, the executive management of AFC, and all colleagues of AFC, we want to say a profound thank you for taking your time to be here. The message is quite simple, but the road ahead requires a lot of work. It requires determination, and it requires execution. And it's not theory, it is practice. Through AFC, we've been able to demonstrate that mobilizing domestic capital can actually raise the capital that are required to spur industrialization on the continent. For example, in the last 12 months, we raised $150 million in equity from pension funds. It sounds like a small number, but that $150 million can be levered up 4 times to $600 million, and we can distribute and syndicate an additional $2.4 billion off the back of that to actually invest in a critical infrastructure project. I just thought to give just some numbers so that people can understand how mobilizing this capital can yield the results on the continent. But then again, I would like to say AFC is obviously your preferred partner in conjunction with AFDB, Citibank, and Standard Bank, and other banks on the continent and beyond. So thank you once again for joining us today. Thank you.
Ladies and gentlemen, thank you for being part of this important conversation. Today's symposium has underscored the power of partnership, innovation, and shared purpose in unlocking Africa's domestic capital to drive sustainable industrialization. On behalf of BCIU and the Africa Finance Corporation, I thank our distinguished speakers, panelists, partners, and including those who are participating virtually for all of your engagement. We look forward to continued collaboration and action in the months ahead. Thank you, and enjoy the rest of your day. I do believe that we might try to take some photos with, if any of the panelists are still here, with some of the key partners. But please do enjoy yourself. Please do have some food, and thank you for attending.